excited to talk about distributed ledger technology and its applications in the financial services industry. And I prepared a pretty simple presentation about. Initially, I'll start by sharing a bit about what distributed ledger technology is, what it actually does, and then I'll discuss a little bit about how we're applying distributed ledger technology in both the payment space and the securities space. And later on, I'll touch a bit more about decentralized finance and the other applications that we could expect to see in the market. Um, okay. So first, what is distributed ledger technology, or what's blockchain technology? I think the best way to describe it really is to compare it with the existing way that we were familiar with, no, with regards to computing. Obviously, there's in any application you have the client, which is the phone or the computer that runs an application. All the computation is done via a server, and all the records are kept in a centralized database accessed by the server. Now, we've always been able to work with this okay when we're just transmitting information, right? We're writing a Word document or sending emails to one another. But this model fails when we try to transmit value, right? Because if I have a digital 1,000 pesos that I'm sending to somebody like JJ, actually the one who controls the database can counterfeit more of that 1,000 pesos, right? So that's what's called the double spend problem. And Bitcoin was actually the first successful product that solves the double spend problem. And it's done through distributed ledger technology. So how does it work? Well, rather than having a centralized database or server, you rely on multiple servers or multiple databases everywhere, right? Distributed. Now, sometimes they're called nodes, validators. For the sake of consistency and efficiency, I'm just going to call them nodes. Now, each of these nodes, I'll speak more about the case of Bitcoin. Each of these nodes keep a copy of the Bitcoin ledger. Now, if I want to send 5 Bitcoins to somebody else, what happens is the Bitcoin protocol enforces validation rules, or what's called the proof of work mechanism, to establish truth or to establish consensus among all these nodes. So if I send 5 Bitcoins to somebody, members or nodes in the network will validate the transaction. And if it's valid, it synchronizes that transaction with everything on the ledger, like with every node on the network. Now, that's the reason why it's deemed to be secure, right? Because it's very difficult, if not impossible, to compromise all of these nodes at the same time. And it's also very difficult to replicate the computing power necessary to take over all of these nodes. Now, Bitcoin was the first application of that, and what's interesting is the model of relying on centralized ledgers or centralized databases is not unique to software applications. In fact, our payments landscape or our payments infrastructure globally relies on centralized parties as well. So let me just show you how it looks now. So here, you see here yung centralized payments. Now, if you have a bank account, the bank is in charge of maintaining a ledger with your deposit balance on it. Now, that bank then maintains a deposit balance with something like a central bank. Okay? So like a BSP DDA or demand deposit account. Now, it has been very efficient for us, reasonably efficient for us to transact through the banking system, because Bank A will just reconcile its records with Bank B and will then reconcile their records with the central bank. And as long as all the records reconcile and match, we as consumers don't see the problem. Now, uh, but since we now have the technology to not require these intermediaries in the payment space, we're starting to realize the efficiencies that can be had with a decentralized payment system. Magandang sinabi kanina ni Commissioner F that in many ways we also have to ask if the efficiencies gained are actually worth it, because in many cases they're not, right? In the case of payments, there are pockets of efficiencies that can really allow democratized access to financial services if we have more of these DLT-based payment systems. I'll give a few examples now of certain challenges that we face in the traditional payments infrastructure. The first is the cost of working capital. Now, you see all the banks here, right? All the banks, all these parties that facilitate payment to one another as part of the payments network, they have to maintain working capital with their counterparties, and they have to maintain and that working capital has cost to it, right? So at any given time, maybe X million or X billion pesos reside idle only to facilitate payment transactions. Uh, another pain point that I think as Filipinos we're quite familiar with is that the cost of remittances are pretty high. Um, for a currency like the Philippine peso that doesn't trade directly with some of the major currencies, everything goes through the US dollar. So in effect, if somebody is from Saudi and wants to send money to the Philippines, there will be two FX transactions there, from Saudi Real to the US dollar, and then from the US dollar back to Philippine peso. And because we're going through two FX markets, we're suffering FX spreads twice, and we're also paying remittance fees twice. So uh, there's been various studies conducted on this that indicate that the average cost of remittance for our OFWs is between 7 and 8%, which is staggering because at 8%, uh, if they work for 12 months at a company, for 1 month of that, they're just working for the remittance transaction. So it's pretty staggering. But how can decentralized or distributed ledger technology based payments solve that? Well, with my explanation earlier in Bitcoin, uh, we're actually dealing not with human or person intermediaries here. We're dealing with nodes who are part of the Bitcoin network. And as part of the Bitcoin network, all these nodes run the same protocol. That protocol is open source. It's been reviewed over the past 10 years and found to be robust. And so there's now a lot of trust in the Bitcoin ledger. But it's not a cure all, right? So Bitcoin itself can be very slow. And there's also limits to how many Bitcoins can ever exist. And it also suffers from the problem of, in some respects, it suffers from the problem of being scarce, right? Because uh, as a scarce instrument, the tendency is for Bitcoin to appreciate in value over time, and so people would rather hold it than spend it. But that aside, in this payments infrastructure, what's happening is if I am sending money to somebody from my Bitcoin wallet to somebody else's Bitcoin wallet, there's no central party in between that can either corrupt the database, or that can stop the payment, or that can otherwise charge fees outside of what the Bitcoin network will take as mining fees. So, in a lot of ways, it makes payments more efficient and much cheaper. Um, Now that's Bitcoin, and I'm sure a lot of you already have some background on Bitcoin and blockchain technology. So I'm gonna stop the uh, technological portion of DLT there, and I'll discuss now applications. Uh, Now, aside from Bitcoin, I guess this is if Bitcoin is if Bitcoin was the first application of blockchain technology, then Ether was probably been the most impactful. Okay, what is Ethereum? Okay, uh, Bitcoin, even though it was in itself a technological marvel, it was also painfully limited. The only thing that the Bitcoin ledger can do is keep track of how many Bitcoins a particular wallet holds. That itself is not very useful um, for other applications. Now, Ethereum is a platform that uh, allows developers, allows entrepreneurs to create services using distributed ledger technology. Uh, so in today you hear a lot about smart contracts. What are smart contracts? Think of smart contracts as programs on the Ethereum platform that run without any more triggering from the authors of that contract, right? I think in the maybe in the legal community, when we sign contracts, sometimes the principals don't fulfill the transactions, right? Or sometimes, in order to ensure fulfillment, we rely on intermediaries like trustees or nominees or agents to verify and actually remove the risk of execution. In the Ethereum, in the world of Ethereum, that is taken that part is handled already by the smart contracts. That's why there are applications or there are use cases that are a good fit for smart contracts. So one example, and I think Commissioner F kind of touched on a bit earlier, is if you have a, if for example you trade a security in the market and you want to ensure DVP or kaliwaan, right now it's very difficult for market participants to do complete kaliwaan, right? There will always be something that will happen first. The transfer of the security or the payment gets wired first. Uh, but you can actually design a smart contract such that one party puts the payment and then the other party puts in the commodity or the security. And then once the contract has validated that indeed ito yung price na napagkasunduan, it will perform the transfers directly. Right? So that's a piece of technology that can replace a lot of existing manpower in the financial services industry. Now, I'll talk a bit more about there are a lot of applications of the technology outside of finance, right? Like in real estate, identity. Eventually, if we have identity on the blockchain or on DLT, there's a lot of services that we can unlock, right? If, for example, the database that tracks our identity is the same database that's used for example, elections or figuring out who has a driver's license or not, um, or determining if someone is deceased or not, then all of these other services can rely on that database. So you might be in a position to eliminate voter fraud or insurance fraud or other types of fraud because you're all relying on an identity database that's impossible or virtually impossible to corrupt. But for this discussion, and I guess to keep things pretty short and focused, we'll focus on applications in finance, uh, specifically in securities. All right. Now, kanina, Commissioner F actually also has a slide similar to this where he discusses um, the how the current capital market infrastructure is set up. Uh, so if you've ever owned a share of stock, for example, a PLDT share, um, actually your name does not will most likely not appear on the transfer agent's records of PLDT, and that is because the financial market infrastructure has evolved such that we now rely on nominees. How did that happen? Well, before, as you know, most securities were in certificate form or paper form, right? If you want to sell that security, you physically go to the stock exchange, hire a broker, and then that broker will go around the exchange, look for the best price, and then sell it for you on your behalf. But as markets sped up, the need to facilitate settlements much faster and much more accurately um, drove the demand for these certificates to just be centralized somewhere by someone who will then just keep track of how many shares are owned by person A, B, C, and D. Now, here in the Philippine setting, we actually have depositories that fulfill this role. For the equities market, we have the Philippine Central Depository, or CPDTC, Philippine Depository and Trust Company. Now, what they do is they actually appear as the nominee sa records ng transfer agent or ng issuer. And in that, in the records of the depository, that's where the depository would then name who the custodians or the trustees are, or the brokers. And then in the records of the brokers and the custodians, you might see more brokers, more trustees. So suffice it to say that the nominee-based traditional infrastructure has created a lot of layers between the issuer and the actual beneficial owner. Is that a problem? Uh, Not. It hasn't been a problem really before, right? I think it was a substantial improvement to trading physical securities or physical certificates. But as the market becomes much bigger and much faster, we're starting to see the problems inherent to this nominee-based model. A lot of times when PDAX talks about the inefficiencies of a nominee-based infrastructure, uh, people tend to think of efficiencies in the form of manual processes, right? Marami kasing papel, mabagal, different systems are being used, etc. Yes, I think if we had a, if we use, for example, if we used DLT to record ownership in terms of security tokens and digital asset wallets rather than records with a custodian, sub-custodian, and broker, we might have those efficiency gains. But we feel that the bigger benefit actually comes from expanding market access. Okay? What do I mean by that? What I mean is that because this nominee-based model relies on parties in the middle who need to profit from the transaction, we have a market failure, right? The guys in the middle do not have the economic incentive to service the entire archipelago, because they might set up branches in small municipalities in the far-flung areas where they cannot get enough customers to support the branch. They just decide not to do it, right? Or because the processing required to onboard a customer is too tedious and too manual, uh, then they don't accept clients with under 10,000 pesos in portfolio holdings, or 5,000 pesos. Or in some cases, in the cases of private banks, they don't accept clients under $1 million. Okay, so the problem there is the issuer has every incentive to access a wider market, right? Even if an investor only has 500 pesos to sell or 500 pesos to invest, the issuer would want to receive that funding, but because the intermediaries are not giving access to the issuer, uh, market failure is what happens. Uh, and historically, this has been a problem for a lot of developing economies, not just the Philippines. I think over the past decade, uh, various efforts have been done to encourage wider adoption of investment products, but still the fact that as a whole or structurally, it's still too expensive to service everybody. Our market penetration is still in the low 1 or 2%. Um, Now, uh, later I'll discuss a bit about how security tokens or digital assets can change this. Um, but this is what a digital asset infrastructure looks like. Okay. Uh, Kanina, Commissioner F was talking about disintermediation being what can happen if we adopt digital assets. True, some roles will be disintermediated, but actually not all. For instance, there are roles that probably a centralized party is still in the best position to do. Okay, a good example would be onboarding a client, right? Um, Today, AML laws apply on people. Someone has to vet an incoming client, or someone has to run background checks. Someone has to approve it. So that one still needs to be done by an intermediary, or someone has to advise the client on what to buy or what not to buy. Someone needs to perform a risk profile assessment on the client. So a lot of these roles will still stay. However, there are roles that probably will be automated, right? For example, if you're holding a bond, government bond that pays interest every quarter, 3%, let's say, uh, that that obligation has actually been pre-agreed at issuance, right? So throughout the life of that instrument, you actually no longer need somebody to manually facilitate those payments or to manually make those payments. Um, and uh, and historically, our financial services institutions have had to raise their operating standards such that the reconciliation requirements are also very high today. Um, you have armies of analysts performing reconciliation work at many of these institutions. So what can be replaced? You can replace the record keeping system. You can replace the paying agent or the facility agent who's in charge of paying the coupon interest on a fixed income security. You can also achieve real time kaliwaan. Okay? So this is what it can look like. Now, because these parties in the middle, okay, are built on smart contracts that actually cost very little to the entire value chain, you can now provide access to the smaller investors and the smaller issuers. Right now, if you're a small company and you want to raise, uh, let's say, 1 million pesos in capital, you actually will not be able to go to the financial market. It's not efficient for an investment bank to service you, and it's not efficient for the stock market to list your security. If you're an investor, uh, particularly small investors, those who only have 2,000, 3,000 pesos, or even less than that to invest, right now they're unable to participate in the market. So by digitizing the intermediaries, you actually make the entire value chain much cheaper, and so you can allow for greater access at both sides of the market. All right. So, in a nutshell, that's what's happening in our securities industry. Not just ours, to be frank, but a lot of securities around the world, securities industries around the world. Except that our market is unique in that we're also suffering from uh, market failures, right? That's why the penetration rate has been low. Whereas in a developed market like the US, these problems that these problems are not as limiting to the US. But they'll still probably have efficiency gains, not as much as a market like the Philippines. I'll share with you a bit about uh, how digital assets are being created now. Okay. Uh, in so 2017 there were a lot of ICOs, a lot of scam coins, etc. But the space has since cleaned up, right? And the tokens that you're seeing now gain a lot of traction or a lot of adoption are the ones that have actual underlying value, and that's probably the easiest digital asset to issue and to launch within the existing securities rules. Because it's no, as Commissioner F said, it's no different from how securities are being exchanged today. We're just substituting one form for another. What is Pax Gold? Okay? Pax Gold is a digital asset with a finite supply that you can inspect on the blockchain, that corresponds to an equivalent amount of gold held in uh, uh, gold storage, or in held with a gold custodian. So let's say one Pax G corresponds to, for example, 1 ounce of gold. You can actually uh, take your Pax G tokens and go to Paxos, the company, and redeem the actual physical gold. Right? So there's one-to-one backing between Pax G and the underlying gold. Now, why is this even revolutionary? Uh, a lot of markets today actually don't have a market for gold. In the US, definitely you can buy gold, right? You can buy gold strips or gold futures. You can also buy gold CFDs. Um, but in many emerging markets, there's no gold market. In fact, in the Philippines, if the fortune teller tells you na, oh, you should buy gold because price is gonna go up, what you might do is buy jewelry, which is an impure form of exposure to gold, because sometimes mas valuable ang bracelet, sometimes mas valuable ang kwentas, sometimes the purity of the gold is not consistent. So you encounter all these problems. But that's typically how we invest in gold today: gold watches, gold jewelry. Um, but if we just want pure gold exposure, we have to go to maybe an offshore broker to gain access. But with Pax Gold, uh, we can transmit gold globally at a fraction of what it costs today. In fact, it's very difficult to move gold around these days, right? You need armored trucks, you need security guards, and when you store gold, you need bunkers that are heavily guarded. But with PaxG, you can carry it with you digitally in your digital wallet, and then transfer gold as easily as sending an instant message. Another similar a stable coin. So they're called stable coins. So another stable coin that's pretty popular is USDC, which is a dollar stable coin. What is that? It is a token. USDC is a token that's backed by the dollar 1:1. Who ensures the backing? Okay. Uh, well, there's a cash custodian. One of the more, well, actually a few of the more prominent custodians in the U.S. Bank of New York Mellon, Northern Trust. They also maintain cash custody for some of these stable coins. So what do they do? This is a simplified explanation. What they do is they inspect the distributed ledger. Uh, how many USDCs are in circulation? Let's say it's 100 million. And then they check the vault. They check the vault to make sure that they have $100 million in cash as reserve backing the USDCs that are in circulation. Now, what does this do? Okay, uh, some people might say, well, uh, here, I mean, in the US, some people might say, I can transfer money using PayPal or Venmo. Why do I need USDC? Okay. Uh, well, in countries where access to the US dollar is restricted, um, USDC can actually be very useful. And also in parts of the world where financial services penetration is low, USDC can be a viable means of making cross-border payments. In fact, today this is happening with Tether, which is another dollar stable coin. Um, Historically, it's been very difficult to access the Chinese yuan or the RMB to make payments to suppliers in China, and that's because of the currency exchange restrictions. But if suppliers in China accept stable coins, then you can facilitate payments to suppliers in a matter of minutes, without any particular intermediary imposing fees uh, or stopping the transaction altogether. Uh, Now, another advantage of dollar stable coins, and I can't emphasize this enough, is that it bridges the gap between the real economy and the decentralized economy. Okay, and I'm going to talk to you a bit about DeFi right after I talk about bonds.ph. We'll go to DeFi. With bonds.ph, really, what we're doing here is we're trying to make bonds more accessible to the average consumer or even to the unbanked. Uh, the cost of maintaining the registry of scriptless securities is currently shouldered by the Bureau of Treasury and the participating banks. Okay, so it's not open to just everyone. And in fact, uh, the 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 investment needed to put up an operation to conduct reconciliations, facilitate transactions on that registry is quite high, that it's impossible for them to uh, economically make investment products available at denominations of 100 pesos or 500 pesos. So bonds.ph actually uses a distributed ledger as a record keeping system. Uh, for bonds.ph, actually, we still maintain the ownership records of the underlying security in ROS, but we do have a blockchain enabled component to replicate that, to kind of see how it works and learn from whatever we run no, in this pilot. Um, so what's the difference in cost? Right now, it costs us about 5 to 10 pesos every day to maintain the ledger, which is massively cheaper than what you would expect a bank or a financial intermediary to pay. Okay, so hopefully, eventually, we can expand the use of that ledger to also take over the process of paying out coupons, or also the process of exchanging that particular security for cash. Okay, so now let's move into DeFi. What is decentralized finance? Okay, you hear this a lot these days, no? More as buzzwords than anything else. But the opposite kasi is centralized finance, which is everything we know about finance today. We have banks, we have brokers, we have insurance companies, we have fintech companies. DeFi is financial services without the financial services intermediary. Okay? So what are examples of this today? Today, we actually have decentralized exchanges. PDAX is a centralized exchange. I'm a human being. We have a team of human beings processing transactions on a daily basis. But in a decentralized exchange, you don't have that. A buyer or a seller will go onto a decentralized exchange platform, place an order to, let's say, buy Bitcoin, and the let's say uh, the the person is gonna pay in Ether. uh, that contract is an open contract for somebody else to say, hey, all right, I will sell you X Bitcoin for your offer. Right? And then the smart contract is triggered, parties agreed, and so the smart contract just executes the kaliwaan. Uh, is is this efficient? Um, well, you've eliminated all the intermediaries. Yes, but that doesn't necessarily mean it's more efficient. Okay, there are problems with this in that uh, because transactions uh, on the blockchain can be very slow. You also don't have a lot of uh, big institutions participating in decentralized markets. So if you don't have big institutions trading in these markets, there's no liquidity, right? So on a DEX, uh, you will suffer a massive liquidity discount. In many cases, pretty substantial liquidity discounts. And even then, you might not be able to buy as much as you want. There are also problems with regards to how compatible DEXs are with existing regulatory frameworks. Obviously, we cannot facilitate transactions if there's unmitigated money laundering risk, right? Someone has to make sure that AML rules are complied with, and someone has to monitor the transactions of the parties. So DEXs can be seen as incompatible with existing AML frameworks. Um, and because of that, banks, funds, or these high volume traders might not might not trade on dexes until that's resolved. We also have decentralized money markets. Okay, so what's money markets? Well, these are products. These are borrowing and lending products. Okay, I think over the past quarter, we saw a spike in decentralized money markets activity, which I'll touch on a bit in this next slide. No? But suffice it to say, na, well, here it is in a nutshell. No, now people are holding a lot of cryptocurrencies. Okay, but these cryptocurrencies represent idle value, right? If I buy Bitcoin, that value there is locked in Bitcoin. It's not put to work, right? So what decentralized money markets are trying to do is they're trying to give you a rate of return on that cryptocurrency so that there's an opportunity cost to holding, and there's also a borrower's market that you can service. How do they do that today? Well, I'll explain later how Compound does it. Um, but typically, because decentralized borrowers or lenders are unable to conduct credit risk on a potential borrower, a lot of these loans are collateralized by other cryptocurrencies. And then last, this one, I think JJ also touched on earlier. We also have decentralized insurance products. How does that work? Well, right now, the only thing that are insured are smart contract failures. Okay. I'll explain later what this interesting company, Nexus Mutual, actually does. All right. DAI. What is DAI? DAI is another US dollar stablecoin. However, unlike the USDC, the DAI does not have an underlying US dollar kept in reserve by a custodian. Instead, it works on a structure of collateralized obligations where whenever the price of Ether goes up or down, the contract becomes more attractive to a borrower or a lender and results in DAI always being pegged to the US dollar. Okay. So if you're interested to know how exactly that happens, you can visit the MakerDAO site or you can download the DAI white paper and it will explain to you how smart contracts using the price of Ethereum and other, you can actually collateralize other Ethereum based tokens to help maintain the price of DAI in one to $1. Now, is this better than USDC? Well, it's more capital efficient, right? Because you're not actually locking up physical US dollars. But I guess the downside is that this is exposed to catastrophic risks in Ether, right? If Ether's price goes down, what happens is actually the collateralizations or the collateralized loans that facilitate the stability of DAI will trigger more selling, right? So DAI can, Ether can actually plummet in value, and then you might see DAI go the same way. Uh, Compound, okay, that's another popular DeFi institution today. What they do is they actually offer crypto borrowing and lending. Okay, so like any money market, if I have cash, I can put it in a time deposit. I'll earn interest rates. If I have excess cash, I can lend it, or if I need cash, I can go to the money market and borrow cash. So in the same way, you can actually also go to Compound and borrow cryptocurrency. Okay, but because they can't really assess credit risk, you are able to borrow by staking in other cryptocurrencies. Let's say I want to borrow DAI, I will pledge Ether to borrow DAI. Okay, so a lot of these loans are over collateralized in such a way that these companies actually can earn pretty high returns off of just originating these loans. Now, uh, there are so I guess the what so question number one is okay, ang daming-daming sinasabi nitong si Nichel. Is it useful? Okay? Pwede ba akong pumunta dyan and manghiram ng Ether so that I can spend it um, here in the Philippines for actual goods and services? Short answer is yes. Um, can you lend cryptocurrencies to compound and earn an interest rate? The short answer is yes. However, here's the problem. The problem is, unlike traditional money markets, when you in traditional markets, when you lend money to an institution, that money is actually put to work in creating economic value. Okay, uh, I lent money to BDO via a time deposit. DBO lent to this small business that uh, profits, pays BDO back with interest, and I get a portion of that interest. So there's underlying economic value being created. But in the case of DeFi loans and deposits, uh, the return or the yield that you're getting largely comes from financial market activity, right? Mispricings in the secondary market, right? Sometimes you see arbitrage, or sometimes it's also a case of mispriced markets, like or uh, hyped markets, right? Um, uh, it's happened in the past where issuers of tokens will hype so much the value of a particular token that a lot of people buy into the token, prices go up, and so they're able to borrow more against that particular currency. And then when the currency comes crashing down, loans are called, and then nothing gets repaid. So that's happened before. So it's very important to also pay attention to where the underlying economic value is being created. Uh, there are also risks now because DeFi is new. There are also inherent risks to the existing smart contracts. Some of them are not foolproof. In fact, Compound itself has suffered a compromise in its smart contract that resulted in, I think, the loss of 120 or 115 bitcoins. Okay, so uh, basically, when you borrow money, you stake tokens into the smart contract. But if that's not secure, or there's a loophole in how it's designed, someone can attack that and actually take the cash or take the Bitcoin. Last that I'll discuss briefly is decentralized insurance. So Nexus Mutual is a great example. Actually, how does it work? Uh, uh, in the Nexus Mutual network, you have parties known as risk validators. Right. So I'll explain what risk validators are, but they're a decentralized group of validators who get rewarded for assessing the outcome of a contract, right, or an insurance contract. So let's say I go to Nexus uh, and then I pay a premium. Okay? I pay a premium to be covered for the performance of smart contract X. Okay, I don't like doesn't have to do anything magical. Okay, let's just say smart contract X is supposed to make payments every 30 days, for example. Okay, I go to Nexus Mutual and say, okay, can you insure me in case this smart contract actually fails? Right? Um, Now, fast forward, let's say 30 days from now, I don't get any payment from this smart contract. I go to Nexus Mutual and say, hey, I want to claim my compensation because the insurance, because the contract failed. What happens then is the validators will study the contract and see if indeed the intention of the smart contract was to pay something every 30 days. If that was the intent, then irrespective of how the smart contract executed it, uh, the validators will say, I'm entitled to receive the insurance benefit. Now, how do they make sure that the risk validators act act right, or really rule correctly on the insurance contract? If you're a risk validator and you go against the crowd, you will be penalized. Right? You'll be penalized in terms of a cryptocurrency called NXM. Uh, if you side with the majority, or if your assessment is aligned with the majority, you get rewarded. So there's incentive to reading it in good faith. But what's the problem? The problem is it works for smart contracts because the risk validators can study the smart contract. They can assess how it's supposed to work and provide insurance coverage if it somehow fails. But can you do that for life insurance? Maybe not yet, right? Not yet. Can you do that for car insurance? Probably not yet. So the use case is still very, very small. Um, but a lot of these technologies, right? To be honest, they're very promising. They're very, very promising. However, promise doesn't necessarily translate to actual rolling out of a particular product, which actually, in order for these products to be rolled out safely and actually viably, you need a market for it. People will need to see the value that it brings to the existing ecosystem and actually be in a position to say, hey, I want that applied to the RTDs, or I want this insurance smart contract protocol to be applied to life insurance or non-life insurance in the Philippines. And then there's also the regulatory framework. I keep saying this about fintech as opposed to other verticals in the tech space. Um, in other verticals, technology is the leading indicator of what gets rolled out in the market, right? So same for Airbnb, Uber, Grab. Once the technology was there to match drivers or to match homeowners with tenants, boom, it rolled out, right? But in the financial services space, the leading indicator is actually what regulators uh, are open to. Right? So if there is no viable regulated environment for a lot of these um, uh, innovations, many of them will not see the light of day, and sometimes for good reason. So I will stop there because definitely there's a lot of excitement in DeFi. It's still a very new and very risky space, particularly if you're thinking about lending cryptocurrencies to some of these DeFi projects. Um, but the space is evolving very quickly.